Okay, so today we're going to discuss economic growth. I'm going to show you how economic growth can be demonstrated using the aggregate supply and aggregate demand model. And I'm also going to show you the determinants of economic growth, um, especially and more so directly connected to the determinant of potential output or the long run aggregate supply curve. And that's where we begin everything for this video, right? So the long run aggregate supply curve, as a reminder, is the long run trend of the output we would expect in the economy. It's independent of price. As you can see here, the value for the long run aggregate supply curve in our schedule is the same, $18.9 trillion, regardless of what the price level is in the economy. And the assumption here is that because it is a trend for the long run, it should be independent of changes in prices. Now, we come to that conclusion because the long run average supply curve is informed by what our estimate is of potential output. And potential output has a few components that go into it as far as our estimates that are independent of the price level. The first component I'll discuss with you today is the labor market. So, our level of potential output in the economy is at least partially determined by the level of employment that we can sustain in the economy in the long run. This is equivalent to the natural level of employment, and it in this case would be the position in the labor market where the amount of labor available matches the amount of jobs or the amount of labor demanded in the economy, and the price or the real wage that would determine that level. So for our fictional economy here, a real wage of $25 an hour gives us the equilibrium level of employment of 157 million people. So at equilibrium at $25 an hour in real wages, that is a wage stripped with the effects of inflation and deflation stripped out, we see that 157 million people are sustained in the economy. The natural level of employment for our economy is 157 million. So what do we do with that? We take that bit of information and we plug it into something that we would call an aggregate production function. This production function basically takes different components of an economy, and in this case, the major components it takes into consideration are technology, employment levels, and capital levels, and determines what a real level of output would be expected from all these values. So in this tab, you can see that I've actually broken out the equation, the most common equation used for an aggregate production function, which is the Cobbs-Douglas production function equation. The K in the equation is real gross private domestic investment, or the investment in capital in the economy that we assume in this case is real GPDI. This is just a value for capital, and you can see in our equation we assume it's basically a constant, that it's always this $3.4 trillion of capital. There is a column H, for the level of employment in the economy. So this cell basically takes the level of employment from column A and multiplies it times a exponent that is effectively trying to estimate the share of output in an economy attributable to employment. So in this case, the exponent is 0.74, and multiplying the level of employment in the economy by this exponent gives us a value that takes the place of our labor. Finally, we have a value in here for technology, and this effectively is what I typically call the pixie dust in the equation. It's a residual value. It's usually estimated as a residual, and what that means is that it's usually estimated as what is harder to explain after accounting for the effects of capital and labor on output. We assume that what's left over can roughly be bundled into productivity and technology. So in this case, it's a random decimal value that gets us to the value for output once you multiply all three of these together. Once you multiply the effective capital, labor, and technology, we get a level of output that should be expected. So at an employment level of 600 million people, 616 million people, our fictional economy would expect output of $52 trillion. At employment of 24 million people, our expected output for the economy would be $4.6 trillion. So what about 157? At 157 million people, we would expect the output for the economy to be $18.9 trillion. And that's just based on the function, right? The aspect of the function to appreciate is that when you look at it graphically, it's a curve that shows what we call diminishing returns to labor. So what you can see is that additional labor, which is graphed on the x-axis here, does seem to be positively correlated with higher levels of output in the economy. But that positive relationship is teetering off as you get more and more labor into the economy. You can theoretically increase the level of output for an economy by just hiring more people as far as what would be naturally sustainable, by just creating a situation where the naturally sustainable level of employment would be more and more. But that route to expansion only works for so long. After a while, there has to be some other part of this equation that is expanded to adjust for the amount of additional people entering in. It's kind of a too many chefs in a kitchen kind of effect. More people added into an economy as far as employment levels that can be naturally sustained does not necessarily equate to more output for the additional person being hired. The new person being brought into the economy is probably going to create less output than the person before them. So this diminishing returns, you can see in the way that this curve is positively related, but the slope becomes less steep as we move along the x-axis. So with that 157 million now, we have a takeaway that the production for the economy, the output for the economy should be $18.9 trillion. And that goes into informing our long-run aggregate supply curve. So now you can see the long-run aggregate supply curve, no matter what the price level is at $18.9 trillion. And of course, the long-run aggregate supply curve is the trend for where we expect the economy to perform. It's based on potential output. So if we're trying to measure the growth of the economy year over year, what we're going to want to do is not look at the performance in the short run in each given year, but look at what the potential for the economy would be in every given year. So really, it's the long-run aggregate supply curve that informs our understanding of economic growth, and where we expect that long run to be each year is where we would expect the economy to grow in any given year. So theoretically, we could increase the level of employment that would be sustainable in the economy in the natural and at a natural rate, at a sustainable rate. So if I go over here to our inputs, and let's say that I want the demand for labor in the long run to be, instead of 157, let's say we make it 305. What you're going to see now is that at 305, we're going to have a higher level of output in the economy. There shouldn't be a higher price level even in the short run, because this is just really telling us more about the long run determinant. But what we should see is that instead of the long run aggregate supply curve being 18.9 trillion, it's probably going to be somewhere closer to the 20 odds of trillions of dollars of output. So let's go first over to our labor market just to make sure that we have made this change carry through correctly. We can see that yes, our labor market now hypothetically at a real wage of $25 an hour sustains 305 million people. Let's see how that impacts our APF. Yes, so our APF has gone up. Our aggregate production function value for that level of labor has increased at 305 million people. our economy is sustaining an output of around $31 trillion, right? And that $31 trillion should carry over to the long run aggregate supply curve. Boom. Yes, so it's about $31.8 trillion sustained at 305 million people. The only thing we've changed is the level of employment. This long run aggregate supply curve is now in a different position. Instead of being at 18.9 trillion, it is now at 31.8 trillion, only because we increased the natural level of employment that could exist in the economy. This is the only thing we've done to grow the economy, right? We've literally grown real GDP. Real GDP would have been 18.9 trillion. Real GDP is now 31.8 trillion. That happened only because we created a higher level of sustainable employment in the economy. And that should translate to the aggregate supply aggregate demand curve by yes. The long run aggregate supply curve is no longer visible on our graph because the long run aggregate supply is far above the intersection of the short run aggregate supply curve and the aggregate demand curve. So now they intersect far to the left of the economy. Instead of intersecting at a point where they would have been right on top of potential output, because potential output has increased because the natural level of employment is now higher, there is the gap between where the economy is and where the economy could be has grown. And that growth has literally only happened, that gulf, that gap has literally only occurred because we have theoretically grown the economy by increasing one of the real factors of economic growth. If we increased what we could do as well, if we wanted to, right? If we wanted to kind of give the short run a little bit of a chance to catch up with that, is that we could also increase the level of capital, actual capital stock in the economy by increasing the level of investment. Now we go to the firms here and we could increase the amount of investment that they did this year. Let's say it increased by $500 billion. So that the level of investment now is at 4.4 trillion instead of 3.4 trillion, because again it went through the multiplier, right? So at 4.4 trillion, we should see aggregate supply intersecting a little bit. Yes, okay, so the aggregate supply curve has actually shifted over to the has actually shifted a bit over, it seems, to the right, and is now intersecting with the aggregate demand curve at a far higher level. I mean, again, the change to investment is in addition to the aggregate demand curve, but it also does shift the aggregate supply curve. And what we would see then is that, yes, the long run aggregate supply curve has also increased. Why has the long run aggregate supply curve increased along with the aggregate demand curve? They've both shifted to the right because our change in investment has also changed the level of capital in the economy. And now instead of having the 3.4 trillion for capital, we have 4.4 trillion. So at the 305 people that we were able to employ before, instead of them only making around $31.1 trillion or $31.8 trillion, I think, of output, they're now capable of making $50.6 trillion of output because the level of capital has also increased in the economy. So we've gone over the two ways to simulate economic growth, the two major ways to simulate economic growth in this. We could also change the technology factor production, which would be the kind of third way. So if we go to technology in the aggregate supply curve here, and we instead add to TFP, let's add 0.02, whatever this residual would count for, you're going to see that that increase is also going to shift the long run aggregate supply curve. And indeed, it has gone now from 50 trillion to $68 trillion. So all these things that we've done to change the economy were independent of price levels. We just increased the natural level of employment. We increased the stock of capital in the economy, and we increased the use of technology or the power of technology in the economy. And all these things have shifted the long run aggregate supply curve to the right, which is how we graphically show economic growth through the aggregate supply and aggregate demand model. That means that the potential output of the economy has shifted, and therefore, if we were performing just at potential before, but now we've done all these investments or we have all this potential, now our economy would technically be underperforming and it would have room to match its potential, right? But again, economic growth is only defined in terms of this potential output. So we're really just looking at the long run aggregate supply curve and concerned about where its position is. And that is largely influenced by technology, the natural level of employment, and the level of capital in the economy.